Welcome, everyone. Thank you for coming today. We're going to have an interesting panel discussion about venture studios, driving innovation from ideation to success. And several of my colleagues here are some of the world's experts on venture studios. And I'd like to introduce Byron Dailey, Jonathan Sagot, and Sarah Chambless. My name is Mark Stevens. Why don't we start with just some brief introductions? And what is your journey to being involved in the venture studio space as it is emerging?
I'm Byron Dailey. I lead the firm's fund formation practice. I got initially involved with venture studios because in our venture fund formation practice, I started to see some venture studios come across my desk and was puzzled about how people chose how to organize them. They seemed to not be well thought out, and so started researching to see the best ways to do this, found that there was not a lot of well-developed or properly developed thought on this, and so that led to a lot of months working on how best to do it. And so that then led to me getting an opportunity to speak on a podcast about a year and a half ago, which led to a lot of venture studio clients coming to us. Then that gave us a lot of repetitions and seeing a lot of variety, which led to further developing my ideas about how best to structure venture studios. And then as a result of that, I wrote a white paper and published it in January of 2024 about how we then thought was the best ways to organize venture studios and structure them. And that has continued to lead to a lot of people around the world reaching out to us for help with that.
Jonathan?
I'm a partner in our startup and venture group, and that means when I'm on the company side, I act as general outside counsel for my clients, and I help deploy the firm's resources for them and help them build these incredible companies. And on the investor side, that means that I'm helping our clients invest in startups or doing more innovative structures, which is where some of my venture studio experience and journey really began. It actually began before I joined Fenwick, when I was representing companies who had venture studios in their cap table and got to see some of the different structures that were deployed then. I mean, that was as far back as 10 years ago. And then coming to Fenwick, doing work with some investors who are deploying funds in follow-on situations out of venture studios, or working with large corporates that were building something that they weren't calling a venture studio, but at its core really was, where they were spinning out IP that instead of letting it just sort of die internally in R&D, they decided that they were going to create a new startup. And that was, years ago, and really gave rise to a lot of the learnings that we've been able to apply here. In my role in this practice, and Sarah and I work together a lot on this stuff, is we really help our clients deploy the infrastructure for spinning out these startups to make it repeatable, relatively frictionless, and to try to set these companies up that are being spun out for success over the long term.
Sarah?
So I'm Sarah Chambless, and Jonathan's based on the East Coast. I'm based on the West Coast, but we are two sides of the same coin in many respects. I'm really at my core a startup attorney, so I help very fast scaling companies at all stages of their lifespan. And where I've come to the venture studio practice is really on the EIR programming, structuring, spin out and greenlighting process, and then portfolio company structuring and repeatability side of things. So we work with Byron after a fund has been formed and funded, and now the operators of the fund are thinking about what's next and when do they greenlight, when do they spin out, how to best structure the cap table for long-term success and inevitably investment from other outside investors.
And I'm Mark Stevens, maybe one of the OGs in this, because the first venture studio I worked with was about 15 years ago when I got a call from a then prospective client who said, we've got a lot of complexities here, and our existing counsel doesn't seem to have thought through some of the problems we're having. Could you come down and chat with us? And that became one of our earliest venture studio companies that we were working with. And if you do it wrong, I can tell you that it doesn't work. It doesn't work in very bad ways. It's important to get the right structure at the outset. So let's just set the table a little bit. Definitions: venture studio versus venture capitalist. How is it different from a classic venture capital firm?
If you think of a venture capital firm as an organization that pools capital from investors in order to invest into pre-existing companies run by other people, that's a venture capital firm. The difference here is a venture studio in its purest form raises money, pools it, and then instead of investing in pre-existing companies run by other people, it actually plays a fundamental role as a founder of those companies, creating those companies, or at a minimum, helping build them hands-on in the early stages.
You're the one who has the first meeting with the venture studio teams. What do they look like? Who is it that forms the venture studio? And how do you know if they're going to be successful?
Yeah, that's a great question, because we do see quite a few clients who are trying to do this, and not all of them succeed. And so I have started to form some ideas around who are the most successful ones. But fundamentally, they need to be a group of people who have skills, some sort of fundamental skills that can really help multiple companies get started and grow. So the ones that are successful are the ones that have the most credible version of that in their background. They should have played a fundamental role in building at least one successful company, if not more. But secondarily, it's very, since venture studios are still a pretty new concept as far as a sort of widespread thing in the market, despite the fact that there's a few that have been around for a long time, it can be very hard for them to raise capital because it is not a very familiar thing. And so I think that in addition to having a real concrete, credible background in helping to build one or more previous companies hands-on, they have to have a Rolodex of investors who really want to invest. The best versions of them are people who have investors who essentially will tell them, I will invest in you for whatever your next project is, right? Because then they're investing blind. And that's exactly what, the typical fully built venture studio is doing. It's asking investors to give them money like a venture capital firm in a blind pool without knowing what the actual companies are.
And are the skill sets technical in nature? Are these brilliant scientists and engineers? Is it more organizational? Is it marketing? Is it some combination of that? What is there a pattern that you can see?
So what I've seen is a whole variety of answer, like any or all of those things. Basically, if one or more of those skills, if they have that skill to such a high degree that they can add value to helping early stage companies get started and grow. I think a lot of the skills you just described sound a little more like the kind of more accelerator version of venture studios, where they're, hands-on consultants that are acting as founders. The more pure version of a venture studio is where the studio team itself, they have the capability to actually, do the ideation and think up the new companies. But it doesn't have to be that, because I do see some successful ones where instead they say, hey, we've got just great marketing skills, or we've got great development skills. We have technical, super high level technical AI skills or Web3 skills. And we can help strengthen external founder teams that want to start a company, or we can help them vet new company ideas and create new company ideas. So there's a lot of different varieties of that. And some of them, it's more management, company building expertise that they're bringing to people who have technical expertise or scientific expertise who don't really have experience or knowledge about how to build a company. And that's what they plug into the venture studio for.
And Jonathan and Sarah, on this, when you're interacting with the founders of a venture studio, do they feel more like venture capitalists that you see in your practice, or do they feel more like entrepreneurs, or is it some kind of a mix of the two?
I would say it depends on where they're coming from. Jonathan mentioned our corporate venture practice, and I think in that context, they tend to feel more like operators who are potentially less sophisticated in venture capital investing. But I would say just as regularly, we do interface with venture capital investors that are beginning to flex into this space because they realize the importance of capturing more equity at the early stages in exchange for a more meaningful participation stake in that early ideation and de-risking process. And maybe they do have an operator background, which is a predecessor to their investment background, and they're hearkening back to that. I don't know, Jonathan, what do you see?
There's a big mix, candidly, but I think the ones that are the most successful are those that bring a diversity of experiences. So you'll have at least someone on the team who has been successful at raising multiple rounds of financing, either at a startup or at another fund. You will also have at least one person who is a really capable operator. And that may mean that they are really good at product development. So they could be just like a really talented engineer who knows how to build out these products. It could be someone who, with the help of another person that has really strong technical expertise, is really good at validating whether a product can be successful, and they can develop a really strong go-to-market strategy. And there's always someone, it could be the same person too, right? Because people can wear multiple hats, that are good at scaling something, usually because they've been a founder. So they're bringing, I think, the sort of grit and risk-taking intuition to these enterprises that allows them to say, this is an idea I want to put a bet on. And how do I develop the conviction to know that this particular idea is going to be successful, so I can convince investors to put money into it, not just those that are coming from the studio itself, because at that point they've already put the money in. We've spun this thing out. I now need to go convince the market that this is a fantastic idea and you want to invest in it. Because the most successful studios are not just the ones that can greenlight an idea, put it into a startup, and say, good luck, right? The best ones are the ones that can do all of those things, but not just say good luck to them. Make sure that they are setting that company up for a lot of success, so that when it comes time for graduation, right, when it comes time to get a third party to put money into the company, at that point, they're helping land those deals and ensuring that the company feels supported as they finally go out into the world, right? Anybody can show up, build a company, put some money into it and say all right, good luck. But the really good ones are helping beyond that.
So fundraising is a core competency of any successful venture studio.
Oh, for sure. I mean, you're not going to get the fund off the ground unless you can.
Right. But it goes beyond that.
Sure. Now, the skills there's crossover in that, right?
Where do the studio investors come from? What do they look like? Is this the Harvard Endowment Fund? Is this CalPERS? Or is this a different set of investors who come into the venture studio investment?
I think in the current sort of state of the development of this market, which is we're early, those are not the kinds of investors that we tend to see. There's an overlap with the kinds of investors we see in venture capital funds, but it's a bigger overlap with what you see in earlier venture capital funds, emerging fund managers. So less of the big institutional pension funds and endowments, more of the family offices, high net worth individuals, and strategic investors, corporations, a lot of the time tech companies, not always, sometimes other companies that want to, who might also be interested in strategic investments in the companies that are going to come out of these. But interestingly, I've been a little bit surprised to see that prominent venture capital firms come in as investors into studios. There's two big reasons that I can immediately think of for that. One is that they already understand what this is that they're investing in. And number two, they are investing in venture studios that they are betting are going to produce companies that they want to be first in line to invest in when it's time to invest.
Proprietary deal flow.
Yes. Yes. I've heard some VCs that have invested big checks into venture studios. I more or less consider you to be my in-house venture studio.
How about the portfolio companies themselves? So we talked about the venture studio founders. Where do the portfolio company executives / entrepreneurs come from? And what do they look like? And how are they different from the person who on her own will start a company and raise money directly?
So I think this is actually part of the secret sauce that can be a critical differentiating factor of one venture studio versus another, where your talent pool comes from and the composition of that pool. To boil it down, what does your EIR program look like? Your entrepreneur in residence program. So these are the individuals that are incentivized to join the studio, essentially to ideate and to execute at the very, very early stages prior to green light and then potentially after green light. And I think we've seen a pretty eclectic mix of approaches, even in the early days of this. Like, some studios may decide to form a pool of really highly competent technical talent, software engineers that are, to Byron's point, really good at developing in AI or edge computing. We also do see venture studios tapping on the shoulders of exited entrepreneurs who they've had a successful exit, maybe even two, and now they're itching to get back into the game and they're looking for a sandbox to play in. So we've seen some of those, but I think actually your access to talent is a little bit like proprietary deal flow for the studio and a great way to differentiate the studio.
So I agree with all that. One of the interesting things I think about this model is, first, talent acquisition is a core competency for a venture studio. Like, if you can't recruit people to these startups, you're not going to be successful because your internal team is only going to have so much bandwidth to commit to each of these companies for so long, right? It is also not necessarily a slam dunk that you are going to be able to recruit serial entrepreneurs every time to come to every one of these companies. So what I have seen in a lot of the companies that are getting spun out is you have a lot of first-time founders. And sometimes the studio is fortunate enough to be able to pair a first-time founder with someone who's been in the startup game before. Not necessarily had like an enormous exit or something like that, but has at least been an early employee at a company before, or ideally been a founder at a company before. But part of being a good venture studio is coaching, is not just recruiting the talent, but it's coaching them up. And you can be successful if you find first-time founders and say, look, I'm going to de-risk this experience for you. This sounds like something you'd really be interested in, but you probably aren't thrilled about going out and doing fundraising because that's one of the hardest things entrepreneurs have to do in the early stage. Companies consumes a ton of bandwidth and involves, you got to have thick skin because people are going to say no to you a lot before you get a yes. And coming to these studios, you can get first-time founders who are in a more supportive environment to say, like, hey, we all believe in this idea together. It's a chance for you to grow. It's a chance for you to do this. And it gives people a chance to really come into their own. And I think that some of our venture studio clients are pursuing that because it gives them access to maybe higher quality talent than they would if they were limiting their pool of candidates to people who are repeat founders.
So let's shift gears a little bit and put on our technical hats and talk about structure. So Byron, you mentioned that when you started working with venture studios, you were frustrated with the variety and the lack of forethought in some of the structures that were being used. And your white paper, kind of helped address that. What are you seeing now in terms of trends? What are you advising? Is it coalescing around a single model? Are there multiple models? Where do you see that going?
Yeah, I see a lot of models come in, but we create a lot of different models that are based on mostly variations on the models that we discussed in the white paper. So I think usually, when I talk to clients who are looking to raise a venture studio, they may or may not have preconceived ideas. Actually, more often than not, they've already read the white paper when they come. And then I spend time talking to them about, well, what's sort of different or special, or what do you want to emphasize, or what are the distinctive qualities of your team, your strategy, your strengths, your potential investors, and then we customize it to that. So I'd say we're not yet in a world for venture studios where, like startups or like venture capital funds, there's pretty much one accepted standard way of doing things. But I think, that there's most of our clients do decide to do some variation on the model that we've called Model A in that white paper, which I could describe as Well, before I describe it, I'll say what's the problematic type of structure that we most often see. And I think historically and still to some extent, it's a structure where someone is thinking like, a corporate startup, their advisor or whoever is thinking like a corporate startup lawyer, and they're thinking, well, you're going to raise money to build a bunch of companies. So you're sort of a version of a startup that's just got a bunch of ideas. So we might as well create a startup for you to do that within, and just think of it as a startup that has a lot of different products or business lines. The problem is that you're not creating products or business lines. You're creating what are supposed to be standalone companies that are going to individually, probably seek exits at different times. And there's a couple of major problems that arise if you do that in a traditional company structure. Number one is that it's probably going to be very tax inefficient. And number two, it's going to get incredibly complicated to layer in investors on top of each other into what really should be a partnership model.
By the way, I mentioned the company that came to us early on, and they had solved the first of those. They had structured as an LLC, but they had been structured with money into the parent company.
Right.
And I ended up being almost a war between the team and the investors because they had very different expectations of what happened next.
Right.
And they had structured themselves into a box. You could get a resolution, but it was not an easy resolution.
Yeah, I have variations on that conversation a lot with clients and with some of their potential anchor investors. And so, to kind of get more into the technical weeds here a little bit, when I'm talking to the clients about this structural sort of problem, I try to push them away from that centralized model. In that respect, we want to structure this, in most cases, more like a fund, more like a venture capital fund, where you've got a central operating entity that's there just to, primarily to serve as something that creates value in each fund that it has. And in the studio case, it's like it's building the companies and putting them into the fund so that the investors are getting in return a portfolio that looks just like a venture capital fund portfolio, but is all made up of stakes in companies that were created and supported by the studio team. So the model that we tend to recommend, the basic sort of starting point is, which again we call Model A in the white paper, which is it's like a venture capital fund in the having those two fundamental entities that I just described, but instead of having carried interest flow up to a GP entity, you have a third entity that holds founder stakes in each of the companies that are put into the investor's portfolio. And so what you end up with is having a model where there's no carry, and the founder stake overall that's issued to all the founders, including the individual co-founders and the studio team in this other vehicle, it should look ideally just like the founder stake on, in terms of its size and the type of securities and when they were issued. It should look just like a regular startup. And I think that's fundamental to this, is that compared to sort of a centralized model or a fund model, you're going to end up with cap tables on these startups that look a lot more like regular startups.
One of the sins to avoid as a startup company is looking weird. If your new investors think that you have a weird cap table, it's problematic. If the new team members think you have a weird... So how does that feel on the company side?
I like to tell people that part of my job as being a good corporate lawyer to my startup clients is I want to make you really boring as a legal matter. Yeah. But so Sarah, you and I have talked about this a lot. Like, what do you think here, in terms of like ideal cap table or sort of do's and don'ts?
Yeah. So I think we operate within a couple of guardrails because there is not an established market yet. We're in a very nascent market. So if you think about your typical startup cap table, what has become, I think, market and accepted is the accelerator stake. the accelerator position on the cap table. Pick your favorite accelerator.
Y Combinator.
Y Combinator. Y Combinator, Techstars, 500 startups. They're probably taking a combination of common stock and then either a convertible instrument or some preferred stock in exchange for actual cash invested. And that common stock is going to sit somewhere between 6 and 12% initially. Now, an accelerator is not investing the kind of time and resources that a venture studio is. On the other hand, where I think Jonathan and I see a lot of pressure is particularly at that first outside investment round at your Series A, where that first outside institutional investor is trying to pattern match this cap table to something that they understand. And if your venture studio is sitting at more than 50%, and particularly if, I think to Byron's point, it's a combined, there's one line on the cap table for both your quote unquote founder stake, for your sweat equity at the studio level, and for your cash investment, you now look a little bit upside down. Your typical venture investor at Series A, they want to invest in the future success of the company, and they want the cap table leverage for future success. So for us, we are saying to our venture studio clients, listen, there's no bright line here, but we really think you need to stay within these guardrails.
And we published, Sarah and I co-wrote another white paper that I think walks through a number of the different models we're seeing. And so go read that. Generally speaking, in addition to what Sarah said, I think that we've seen a number of companies, even before we coalesced as a venture studio practice, where we were on the company side or representing an investor on the investor side. And the problem of the venture studio having way too much of the cap table became a major point of contention, both because the venture studio felt with very real conviction that they were entitled to the equity stake that they had, and the investor felt with very real conviction that the venture studio had no business being, so sizable on the cap table, especially because even if the studio was providing a ton of value early on, at that point in the company's life cycle, they were largely finished. The company had graduated from the program. It was really being run by the individual founders or executives. And there's a very real concern from these investors that I'm investing in this team as much as this idea and this company, and this team is not incentivized enough. And why am I going to put my money in here? And you then, Sarah and I both experienced this, where there has to be a negotiation with the studio to give back equity. And I can't imagine what a mess that must be for the studio itself to go back to their LPs, their investors, and say, hey, sorry, we had to give a whole bunch of equity back on a company that is presumably one of their winners. And I think a lot of this just comes down to planning and infrastructure.
And so define the term dead equity. If you hear that,
okay, to you, panic. But after you panic, it basically means that the equity that's sitting on the cap table is not being put to work. It's not contributing any value to the business. And so let's say we didn't have a venture studio. Let's say we had two founders, one, and let's say their equity was fully vested at the beginning. So lots of problems already. But one owns 70% of the company and the other owned 30. And they work on an idea for a year or so. And the one who owns 70 says, you know what, I'm out, I'd like to do something else. And they leave and they own 70% of the cap table. The remaining founder who's left owns 30%. But they're the only one there building this idea. If a new investor comes in, they're going to say, wait a second, who is this that owns 70% of the cap table? Oh, it's, so-and-so, a really nice person, was here for the first 2 years. And what are they doing now? Nothing.
they're in the Bahamas.
They're, on vacation, I think, they're finding some hobbies or whatever they're doing. And the investor said, well, how are we going to incentivize other people at the company to help grow this thing if 70% of the cap table is on vacation in the Bahamas? And so in that respect, the equity is dead because it's not doing anything, right? It's not an investor who put real money into the company to help it grow. It's not someone who is still actively contributing to the growth of the company through services or otherwise.
Now, the company may believe that the investor equity from prior rounds is also dead equity, but new investors don't take that perspective usually. So you get a pass on the piece that's came from the money for the venture studio.
I think one thing I'd like to add too is when we're thinking about the role that our co-founders play after spin out versus before. During the EIR program, they could be receiving consulting fees or a salary in exchange for their work. And, the venture studio's inclination is certainly to factor that in to how much equity they get in the spin out. How de-risked is that company when we spin it out? And have you actually been eating ramen noodles for 2 years, or have I been paying you more or less a market salary to help develop and de-risk the idea? The problem with that is that our co-founders tend to adopt and internalize their role as co-founders. And when you get to that first outside investment round, the investors will also view them as the founders. And so the studio itself will not have, the person, ironically, who is pitching the company will not defend the studio's position on the cap table in those conversations. So all of this is a dance, and it does evolve over time. And one of the things that we coach our companies or our venture studios on is really that long-term thinking. Think about this all the way through your first round, how it will be viewed, who will defend it, how will you defend it, how does it look on paper? Is it defensible on paper via services agreements or something the like? So
and there are cap tables in my experience that are uninvestable.
Correct.
That is, it might be a great idea, it might be a terrific business, but because of problems that you bury in your cap table, you may never, ever raise money. And so this is not a nice to have, this is a must have to have a cap table that is appropriate for the next round of financing and beyond. So Byron, I want to come back to you. So if venture studio founding team comes to you, and they go out to market and they come back to you and say, we're first time venture studio people. We can't get people to give us checks to play with as we please. What are some of the training wheels version of venture studio financing that you can help them through?
Yeah, this is a question that we get a lot, and I have seen, a few different successful strategies to, some people refer to it as the cold start problem, where it's really hard, with a, newish concept to say, I'm going to raise my first venture studio, just trust me, I'm going to build some good companies. And they sort of run into a lot of skepticism. So some easier versions that we've seen work are, one is if you have the wherewithal, self-fund it. If you have enough to at least start 1 or 2 companies with your internal team's cash, that can work. And then you can set that up within a super simple initial just single vehicle structure so that it's all done sort of under the auspices of the venture studio within your brand and with your team, so that it starts to create a track record. And so that can be one version of that. Another,
Similar to a warehouse deal that a venture capitalist might have, or
similar in a way where when you see a deal, an investment opportunity that's there with a deadline that's prior to you being able to raise your fund, and so you find a way to make the investment and then roll it into your fund. So it's similar to warehouse deals that are self-funded by the GPs in that way. And you can sort of turn those into warehouse deals by saying, look, we've started these 2 really interesting companies to show that we can do this. And once we raise Studio Fund 1, we will roll these into it, so you'll get a piece of those. Another version that we've seen work is if the studio team, before raising any money, can just come up with the first company idea, and then they're basically, it's like a variation on acting like startup founders. They're saying, here's our first company idea, and then instead of raising money just directly into a startup, they want to raise it into, again, a simplified infrastructure that's sort of shows that it's under the auspices and under the sort of mechanisms of the ideation and greenlighting that comes with a venture studio, and then raise an SPV that's, specifically just for this company. And we've seen that work a couple of times, because the investor, it may be like a fund of funds or something like that, or a VC that figures out how to invest in an SPV. and they say, okay, I like that idea, I'll invest in that, and your economics through the SPV makes sense to me because it's the only way you're letting me into this. And then do that a couple of times, and then you're going to, again, have a track record of having actually shown that you can do this. It's a proof of concept. Then you can go and raise a blind pool to create the next 5 companies.
How about when the investor says, venture studio, yeah, that's fine, I'm betting on you.
Yeah.
Just sell me an equity interest in the venture studio because that's what I'm really investing in.
Yeah, so that's a super common topic. That is another version of how to get it off the ground. If the first investors you talk to say exactly what you said, hey, I'm betting on you, I want a piece of the studio. It's a phenomenon we see very often recently in early stage venture capital funds too, where some certain anchor investors will say, I want to invest in the GP, not just the fund. It's a situation that you have to be very careful with because you can quickly get yourself diluted. You quickly could end up, if you do this more than with just a couple of investors, and especially if you do it, more than one time over a period of time, you end up in the situation we first said was a big problem, and especially like the one you described, Mark. It is a way to sort of, take 1 or 2 initial checks and say, okay, I'm going to give you a piece of the mothership. I'm going to give you a piece of my stake in this, not just fund 1. And that is a variation on the self-funding, but you're bringing in a passive investor to be the funder for your self-funding. But we also see that in the way you described it, where you're trying to raise money from a whole group of investors, and one of them says, I want not just a piece of this fund, I'm investing in you. I want to invest in the mothership. It's a situation where my advice is usually try to say no to that if you can get away with it. But if you decide that this is the only way to launch this thing, just be very careful to let in as little of that money as you can get away with to get it launched, so that, again, you don't get as diluted in the perpetual stake that you've got. And then also there's ways to negotiate actually how you structure that stake to try to not make it perpetual potentially. We have clients who say, I'm fine giving them, this small percentage of it forever because I'm so grateful that they helped me launch this thing. And that's perfectly fine. Others say, I'd really like to use this investor's money to help me get this off the ground. And maybe I will give them a special stake in this fund. So they'll get their fund stake, plus they'll get a piece of my economics. But if they're going to participate in my economics of fund 2, they're going to have to re-up and invest at least as much. So there's a whole bunch of variables there for how you can try to contain that investment if you want to.
One more question on funds, and then I want to get to the companies in the green light process. But how do you deal with the fee pressure and the cost pressure? If you just look from the outside and you try to figure out the amount of money that comes into a venture studio and how the heck do they afford their operating expenses, how does that get intermediated?
That's a really tricky question too, because there's a lot of different ways that you can do that. So the question is, if your investors are going to invest in a fund that you raise and you're going to use what are you going to do with that money to fund your operations, where you're going to be doing all this work to build the companies? Because it should be a lot more work than just investing in companies, not to really overly diminish what venture capitalists do, because they have to look at so many companies and look at them hard, but you're actually trying to build companies in-house. And so that it's not only different, but in some ways, in some cases, it can be more work. So there's a lot of different ways to solve that problem. One basic thing to always remember is, almost all of these studios that we create are regulated as investment funds, so investment companies, and it's super important to be transparent with your investors as to what the fees are that are being taken out of there to pay the studio or the management company. I think that one of the most optimal ways to do this, if you can, is to just charge the same kind of management fee that a venture capital fund would charge as step one. 2.5%, say 2 to 3% of the fund is paid to the studio operating company. And if you can do the pre-incorporation work, at least at the outset, just using that much money, then you can flip to a second stage. Once you greenlight and spin out a company and have the fund invest a safe into it, then the company has some dollars in its own bank account, the startup company does. And what you can do is have it then directly engage the studio operating company to provide whatever the necessary services are for the appropriate amount of time. That structure tends to be much more palatable to investors. You can then, given the whole structure that we've talked about, what you can tell investors is, look, I'm raising something that's going to create what's effectively going to be like a venture capital fund portfolio for you, but there's no carried interest, and it's the same fee that you would normally see in a venture capital fund, but we're going to have this, what we call chargeback model, where some of the money that is invested into the companies is going to help fund the outsourcing of the special skills that we have as a venture studio to keep building these companies. And it's, if the investors are investing in you at the outset, they do believe already that you have some special value that you can bring, and so that should resonate with them.
And this, by the way, is a pretty recognized and accepted model, the chargeback model in the accelerator landscape too. So isn't too terribly offensive on the post spin out independent investor kind of first independent dollar in side of things, as long as you're reasonable with it.
And the services are real.
Yes, yeah. And you define them in a document, and so it is all defensible and properly papered. Yeah.
Okay, so let's pivot to greenlight. You each mentioned greenlighting, and I know that this is, we're talking about core competencies of venture studios. Greenlighting is definitely one of those, up with fundraising and the other ones we've mentioned. First, definitionally, Sarah, greenlight, what does it mean?
Yeah, so this is the, call it the Goldilocks moment in the new nascent startup's lifespan, where the idea has been de-risked enough that it is deemed to be ready to spin out. And usually that's some combination of, okay, we've established product market fit, we have some early traction in the marketplace, and probably most critically, we have a team which is going to attach to the startup and become responsible for it post spin out. That's how I would define it. Did I leave anything out?
No, I think that's right. We use the term greenlighting because we all like pretending that we're movie executives. And the way I like to think about it is, if a group of founders were getting together and we're going to build an idea in somebody's garage, right? I don't know why all great ideas start in garages, but that's what I'm told happens. Would they feel enough conviction about the idea to stop whatever else they were doing in their lives and focus just on building this business? How much market validation and traction do you need in order to do that? For some founders, none, right? It is about the conviction of your beliefs, and you've probably done I hope you've done at least some research to figure out that this idea could get off the ground. But for other founders, they will want to do a lot of independent validation of various ideas. Some people, and especially now with AI, because it's so easy to do, you just build your own MVP very quickly and have other people start playing around with a software product and see, like, am I getting enough feedback from that to think that this could be a real company? And venture studios are no different, right? Because it's, people have different ways of thinking about risk. What we would encourage all venture studios to do when we talk about greenlighting is to not wait too long.
Mm-hmm. The greenlight process, product market fit, makes sense in a software environment where you can put something together that might be tested by the market for $1 million or a couple $1 million or whatever. But it's a much different situation in bio if you've got a fundamental science that needs to be developed, hardware development. So that Goldilocks moment is highly industry specific. You know it when you see it. So what are some of the mistakes people make on green lighting? And what are the consequences of those?
Yeah, and this is what I said. The thing you don't want to do is you don't want to wait too long.
Right.
And why is that? If you wait too long and you say, Jonathan, look, I need to feel really, really good about this. I want paid pilots. I want to have customers using the product so that I know that when I put this into a startup, they already have contracts. I'll assign the contracts to the new startup, and we're off to the races. But the problem with that is you've created a lot of real value, not just theoretical value in an idea that we hope will be successful. You've waited to a point where, this thing is actually generating revenue, even if it's in the form of paid pilots. I mean, that creates, and why is that a problem? If you create too much value in a startup before you spin it out, you aren't going to be able to issue common stock to the initial founding team or the initial executives for fractions of a penny a share. You're not going to be able to do it. The reason that you can do that when founders come together and normally, form a startup, they have an idea and they've got some grit and maybe they've done some work on validation.
And they're convinced it's worth $1 billion.
Well,
but
of course,
that conviction does not set valuation.
Conviction does not a valuation make. And they come in and they basically get their equity for free, right? They cut a check to the company for $10, $100, whatever it is. And sometimes not even that. They just sign a document that says, I'm assigning my ideas and then give me this equity and we're going to value the equity at nothing. And that's an amazing thing for founders that if their convictions turn out to be correct and it is $1 billion idea, they get to enjoy the appreciation in that growth, right? They've given up no upside. If, however, you wait too long,
also there's a tax difference.
Yeah, yes. So as with everything in the corporate world, taxes are very important. If you start out as a normal founder, and you buy your equity for fractions of a penny a share, you start your long-term cap gains clock immediately, and that means you have a lower tax rate when you sell. And if you hold the equity for long enough and you're in a qualified business, you may get qualified small business stock treatment, which could mean you have at least $10 million tax-free at the federal level. So there's tax optimization there as well. But if you don't do it that way and you wait too long, what's the problem? Well, if you spin out a company when, let's say, it's worth $1 million, and you have a founder who's going to come in and own 20% of that company, they better be paying at least $200,000 for that equity. Or if the IRS comes knocking later, they're going to say, "Hey, what is this? You got free equity, and you should have paid, should have been $200,000 worth of income. Now you owe the IRS 50, 60, 70, 100 grand, whatever it happens to be." And you want to be attracting founders to these businesses, and they will be more likely to join if they think they're getting in at the ground floor. If you say, "Oh, and good news, we've already invested a bunch of money and you're going to get a stock option," which people know and love, and stock options have a lot of use, and the strike price is $1 a share, and here's 1 million shares, they're going to say, that's $1 million of upside that I don't get to participate in. And why? Because you, venture studio, did not have the strategic foresight in your planning to get this good idea into this new company and recruit a founding team sooner. And so a lot of the value that we add is helping them think through their green light process. What does that actually look like? And it's very different by industry and by studio. And how can we be spinning out ideas ideally as early as possible?
And by the way, all of, not to keep banging on this drum, but all of this enables us to pattern match more closely to what later venture capitalists will expect to see. They don't expect to see founders sitting on the cap table with stock options. They expect to see them meaningfully compensated with, common stock that was valued close to par value at the beginning.
And one problem with stock options, just to make sure that you're aware of this, I have companies that have where the founding team got stock options and they're now hitting 10 years old, and all those stock options are expiring, and that is a cataclysmic problem for the founding team. You also have ordinary income no matter how much you make, because without exercising the stock option, you end up with with not a capital asset. So,
and if they've waited that long to exercise, they're probably foreclosed from QSBS treatment. It's all,
right.
yeah.
So, so Sarah, you call this a Goldilocks moment. I now understand why doing it too late is a problem. What are the problems with doing it too early? Why can't you just spawn a bunch of these things the instant you get an idea, and they're all kind of running around like little kids?
Yeah, you could, and sometimes we do. Yeah. But I think the critical issue there is on the other side, you're dealing with maybe not all the critical components of an operational company actually having coalesced. So, my mind goes primarily to team. You may think we have an idea, we have some early market validation, we have an MVP, we're ready, let's spin it out. But you don't actually have all the team members that you need to propel that company forward, or maybe they are not ready to commit to the enterprise full time. So kind of coming back to your, like, we're building in our garage, when are we ready to quit our day jobs? If you don't have a fully built out team that is ready to quit their day jobs and run this company, and maybe eat ramen noodles for the privilege of doing so, you are probably not ready to spin out.
Yeah, we actually think that, and one of the things we talk to our clients a lot about is, how do you know it's ready? Well, have you been able to recruit people to join the business? Do they have as much belief in the idea? Maybe not as much as you have because you've been living with this idea for longer, but do they have enough belief in the idea that they would quit their day jobs to come and join?
Mm-hmm. And by the way, I think this is one of the inflection points for the new studio. Actually, is sometimes the first spin out of the first portfolio company, where it more likely than not was an internally incubated idea or solution, and now the GPs of the studio, the operators of the studio, are more invested in it than anyone else. So recruiting other people to kind of take the baby away from you is a really critical inflection point in the greenlighting process.
The last thing I'll mention too is we're spending a lot of time talking about tax and optimization for that. If you're just going to spawn a whole bunch of wholly owned subsidiaries and creating a bunch of value there, you're not solving your tax issue. You're still just creating value in yourself for tax purposes. So it's not the creation of the entity that is meaningful. It's the creation of this new startup, which is a combination of moving intellectual property into a new entity and recruiting people to join that entity, which may be, by the way, people who work at the venture studio. There could be, in your example, it's not at all unusual where if you have a group of these GPs that they say like, all right, well, we need one of us to go with the company because we all really believe in this idea, and who wants to do it? And someone will say, will volunteer and say, I will go. And that will almost certainly, at least for a period of time, if not permanently, mean that person is not necessarily going to be able to come back and help spawn a whole bunch of other companies at the studio. But it will, if it's done right, and it comes to establishing a track record like Byron was talking about, I mean, that can create an enormous amount of value for the studio brand long term when one of those GPs raises their hand and say, I want to help run this business.
Mm-hmm. The actual tax moment occurs when you are splitting equity with other founders, and how we value the equity that is being distributed to the co-founder. So just to reinforce Jonathan's point, just pushing down a bunch of subsidiaries doesn't actually solve the tax problem.
It's a creation of the cap too. And I describe this as the moment that concrete starts getting poured and you start losing flexibility. Maybe what you really have is this team and this product needs to be combined with some other team and product in the venture studio. Well, you can't do that anymore once you greenlit. Or maybe you've got a founder who's not going to work out, or you've got to rework the equity split between founders, or there's a lot of different things that you lose the flexibility to do once you take it out of the primordial soup of the venture studio process. But I want to come back to how much equity, what does a typical equity split look like? If you want a pattern match to a normal company, what do those number ranges look like? Does the venture studio's equity have vesting attached to it? How do they think about that so that they can stand up to the VC who comes in later in the Series A and say, nope, this is normal. This is perfectly fine.
Look, they're different models. I think we focus a lot on what is the role of the venture studio in the creation of this business. Is it internally incubated and is it, founders brought us an idea and we're sort of doing more of an accelerator type model, and if you look at, so let's look at the archetypal structure, right? I think what we would consider like the classic venture studio is the venture studio team has incubated the idea, that they've come up with the idea themselves. Most likely, maybe an entrepreneur in residence is going, who was part of the team that helped build the idea, will be going into the startup to be part of the individual co-founding team, and you've recruited individual co-founders, right? So classic model that we would think about. In those structures, it's important to delineate between what we call the founder stake for the studio, which is the common stock stake that the studio receives at incorporation, which is largely for the intellectual property that was created before incorporation, right? So maybe there's some code base that's there. It could be some branding. It will include the idea itself and the work around the idea. And so for that, what should their stake be?
It also includes, by the way, they paid their EIRs and they paid team members to do things while it was this kind of in the scrum.
Yeah.
And so there's real cost that goes into the building of something that they are getting compensated for.
Absolutely, unless somehow the IP was free. But that's got, again, classic model. Yes, we are paying studio employees to develop this idea, right, and to do at least some validation of it. And so for that, we get this, the venture studio gets a common equity stake.
And those studio employees have not taken any salary risk, right? There's, to the extent that founding stock compensates for risk, the only party taking risk here is the studio.
That's correct. That's correct.
And that's an important thing that's embedded in the cap table.
Yeah. And again, unlike an accelerator, right, who is taking some risk with the capital and some opportunity cost because they're letting in one particular startup as opposed to another into their cohort. That's not the type of risk that the studio is taking, right? They're spending money to develop an idea, and that idea either works or it doesn't, but the money they have spent is gone to develop it, right? And so they get their founder stake. So it's a common stock stake, and that's going to be, somewhere between 10 and 20%. It can be, it can be a little higher than that. But generally speaking, that's what we're going to see. And it tends to be, I think, 15 to 20% is generally what we're going to see for that. It can be a little bit bigger.
Yeah, I would add to that when we're, again, kind of thinking about our guardrails and that initial cap table, which is just common stock, no capital has gone into the portco. There's going to be a 10 to 20% equity incentive pool for future talent. And then that remaining 80% gets chopped up between co-founders and studio. And my rule of thumb when I'm talking to studios about this is your stake should not be bigger than the other co-founders. So that 80%, your stake needs to be for sure less than 40.
Your founder stake or your equity
the
stake
founder
for the money?
Yeah, the founder stake. The founder stake.
Important. That's because
yes.
The venture studio is thinking collectively.
They are.
And we need to train them to think about this as
capital is capital.
Right.
Capital comes in and we treat that the way we would treat it on the market. But yes, when we are divvying up the co-founder stakes, I tell them that is the ceiling. That is the absolute ceiling. That is not the floor. So just in terms of these guard rules. And I think that 15 to 20, maybe on the very high end, 25 to 30 is a good place to be.
Yeah. The other way to, and again, so we have the founder stake, and then we have the investor stake. And for the investor stake, if you put a number out there, and I think we do this in our white paper, we sort of assume 20%. But really what dictates the investor stake are the dynamics in the market associated with the investment that the studio is making. So if you're going to invest $2 million into a Series C preferred stock financing, the market would say, and you're the only investor in that round, the market would say, well, you should be getting 15 to 25% of the cap table for that. If you are going to put in $500,000 on a safe, on a simple agreement for future equity, well, it's a lot less clear what the market might say for that. And if you're going to come in and say, well, the cap should be $1 million, right, for my $500,000 investment, implying a 50% ownership, like I can tell you that's way off market. So that's not going to fly. But should the cap be $5 million? Should it be $8 million? Should it be $10 million? There are other things that will go into figuring out what makes sense there. And going back to pattern matching, your investor stake is justifiable if you're doing a market deal. So you shouldn't have to worry that the Series C or Series A investor comes in and says the studio owns too much because you did a $500,000 investment on $1 million post-money cap safe, right? You're not gonna have a lot of leverage in that conversation with the new investors. But if you do $2 million of Series C preferred at an $8 million pre-money valuation, right? So you're getting 20% of the company. It's defensible.
And it becomes even more defensible when, kind of circling back to Byron's structuring points, we internally within the fund structure separate out where the money comes from versus where the sweat equity is sitting. So you have actually a line item on the cap table for your common founder stake for the studio, and you have a separate line item for your safe or your series pre-seed preferred stock.
Let's look into the future a little bit as we wrap up here. What are the problems that you're dealing with right now that are making you scratch your head into venture capital or the venture studio formation? Is it international investors? Is it corporate studios? Where's the next level of complexity here?
I think it's all of those things. It's corporate venture studios tend to have a different model. Setting them up outside the U.S., it tends to shift things a bit because we're dealing with different tax laws, different employment laws, different intellectual property laws, and different corporate laws. And so that strategically it can often work the same way, but the details get worked out a lot different. Also, there's starting to see more people wanting to do venture studio type things that are related to tax exempt organizations, nonprofits, charitable, so impact driven venture studios. So we've been working on that kind of thing. But I think in the bigger picture, it's just that this market is still very new, and it's still still trying to figure out what it looks like to investors. And I think we've made a lot of progress over the last year or two, but I think we still have a long way to go. And I think the biggest one is getting more and more investors familiar with the structure in a way where they understand and are aligned with the studio founders as to who's doing what and who's investing in what. I think there's a lot of development happening in that.
And Jonathan and Sarah, I want to ask you this question. When you're selecting counsel for the portfolio companies at the venture studio and at the founding team, is any emerging company lawyer who's okay with their skills going to be a good fit? Or do you really need to understand how the venture studio works in order to not cause too many problems?
To the extent it's not obvious, it's clear the latter. A lot of what we do, so outside the venture studio world, part of what makes a good startup lawyer is our ability to take friction out of the system because we understand what issues matter and what issues our founders should care about. And we're very good at educating founders about these issues and how they should be managed. Venture studios present unique issues. Venture studios tend to ask for things that may seem slightly unusual, potentially on governance as an example, than a normal venture investor would. And if you get a startup lawyer who may otherwise be very good but has never seen these things before, they will naturally introduce a lot of friction into the system for the sake of what they would deem zealous advocacy for their client. And so I get it. But that's because you haven't seen this thing before and you're like, what's this weird off-market thing? But we see so much of this that what may seem weird and off-market to a more traditional startup lawyer, to us, we can say, look, we have a lot of venture studios. They do this thing and this is why they do it. And here's either why you should care or should not care. And here's where, if you want to raise this issue, how best to raise it, right? And what are the levers that we can pull to maybe optimize positions a bit. I will say quite candidly, this works really well when we have helped the studio build all of the infrastructure, because we spend a lot of time, frankly, guiding studios away from structures that we think are not going to be beneficial to their overall enterprise over the long term, but can come up with solutions to address their concerns. Basically, you have a problem. Let's give you a solution that won't scare off individual co-founders or future investors, right? And you may think that this is a problem. Here's why it's not. Here's why it's not a problem. So if we can start with a venture studio and help them build the infrastructure, and then we can transition to representing the startups that they spin out, which is candidly what we do all the time, that allows us to take a lot of friction out of the system. The studio can have other counsel representing them once they've spun the company out when we transition to the company side, but they're really deploying a model that we've helped them build. So we are best positioned to educate the founders and explain why things are there. And then after you do that deal, frankly, the studio and the founders are aligned, because the studio is essentially a founder anyway.
That's right.
And so I think that's what makes this model, I think, most successful for both the studios themselves and for the startups.
Yeah, I would bring it back to the greenlighting process too. One of the things that enables us to greenlight earlier in the process and kind of nail the right moment is the replicability of the model. So when Jonathan and I are working with a venture studio, we help them create a model that is replicable. And we talk about this a lot in the white paper. And what are the features of a replicable model that the venture capital community will pattern match to? So when we are in this space where we're going, okay, who's going to really deeply understand the nuances within this replicable model? We have to keep it replicable. We can't have counsel coming along to represent the company that is going to want to negotiate this thing. And so again, to Jonathan's point, what tends to work best is where, at the initial funding round, we do spin out and work on the company side. It's preferable for everyone. The venture studio can really take the forum documents that have already been drafted and hand them to any competent investor side venture capital counsel. And it becomes, again, a very efficient and seamless process where now, post spin out, your counsel understands all of the idiosyncrasies of why you are set up the way you are, and we are best positioned to advocate for you. And again, the studio is aligned with you as a co-founder.
And Sarah, you've said to me that one of the things that motivates you working with startup companies is the joy of working with the founding team. Do you feel that with the founding teams of these operating the portfolio companies?
Absolutely. Absolutely. I mean, they are our clients.
Yes.
Absolutely, They are. And again, they internalize the founder role. That's going to make them successful. So yeah, that is one of the joyous things, is like a successful spin out and external funding of a company that's been incubated internally, where now it is completely independent.
Well, there's a lot more to talk about, but we don't have more time. Thank you very much, and I appreciate each of the panel members and the great contributions to the conversation.